So this is the beginning of chapter 4. Now, chapter 4 is just going to be the integration of all the previous lessons, right? And all the previous chapters to finally start hunting for day trading setups. Now, before I can actually teach you what to specifically look for, the entries that I like to take, we need to create some sort of foundation to when to expect the days that these day trading high probability setups are going to be formed. So, chapter 4, lesson 1, we're going to cover elements to a high probability day trading setup. Now, the key points of this lesson is going to be the importance of high time frame premium discount array matrix, what to look for when price trades into them, how to formulate trade ideas within them, how to use premium discount array matrix for profit taking, the importance of displacement. Now, before we go into the elements of what makes a high probability day trading setup, we need to consider the PDRA matrix. Now, this is the absolute backbone of our day trading. If you swing trade as well, this is the backbone of your trading. Without this, you are going to struggle to navigate and have success in the market, right? Now, we will be using the higher time frames, the daily and the 4 hour, to be considering the PDRA matrix. Now, that's not saying that we're disregarding the weekly, right? I'm assuming at this point in the mentorship, you guys should be comfortable with the weekly, how to depict whether the weekly is offering higher or lower prices, and in general, where the higher time frames are pointing to in terms of price, right? But where you actually place the PD array matrix, the high to the low, we're going to consider the daily and the 4 hour, right? And then we're going to consider the premium and the discount of the daily and the 4 hour price ranges, and we're going to be using that to frame our day trading setups, right? Now, as a day trader, we wait for these areas to be traded to before formulating any trade ideas. Now, this is what people do, and this is what you don't do. This is what you don't want to do. Price goes into a 4 hour order block, buy. You don't want to do that, right? You need to wait for certain signatures to occur at these price arrays that we'll cover in this lesson, right? But the arrays, the way you want to view them is high time frame array, trade possibility, and you're hunting at these levels. That's all they are, right? So element one, the first element you have to do or have to consider is you have to depict the PDRA matrix on the high time frame. So this is the Euro USD daily chart. Now we have this high to this low. Now a question you may be asking straight away is why not using this? Well, look at this sideways choppiness, right? I don't want to consider this price action as well. Look at this high and this high. Which one is the clearer one? This one. Now, what's the way I define a high? If it's a three candle formation, so this candle, and that candle, the middle candle's high is greater than the candles before it and after it, and the low is the candle in the middle. The low is lower than the one before it and the one after it. That is high to low. Now, when you depict the high to low, right, this is what you do. You have it, and I like to have my fib with the 1, the zero point 0.5, and the 0, the zero point 0.5 being the equilibrium of the range, right? Now, once you have the PDRA matrix drawn, right, the fib drawn, you want to start labeling it. And that's what makes it the PDRA matrix, because now you have the premium and the discount, but you don't have the arrays. So you need to annotate the arrays onto it. Now, I didn't annotate this fair value gap from this candle's wick to this candle's wick. Consider this order block here. Now, once you have the arrays drawn on your fib, you're considering the trade into it, right? Now, some people may say, well, why can't I just be long until there? You can definitely be long there, but you want to consider the first array, right? So some people may want to be long from here to the 50%, for example, and that's fine. However, always be conscious of the bigger picture because we can just tap into this fair value gap and then offset lower prices, especially if that is the day of a large economic driver, a red folder on the Forex Factory website. So element two, after identifying the premium discount array, you wait for a move into it. There were also premium fair value gaps here and one here that I didn't outline. and you're monitoring the move into each one until displacement is given. And displacement is going to be touched on the next slide. You are waiting for displacement at the arrays. You don't get displacement here, that's fine. You're waiting for this one, and that's fine. You're not getting it still. You're waiting for displacement. You are not just mindlessly pressing buy and sell at these levels. That is what the, less experienced, misinformed traders do. They're just too trigger happy and they're pressing buy and sell. You're not doing that. Especially on a daily chart, you are not doing that. So element 3, once price trades into the premium discount array, right? So in this example, it's a premium. You are waiting for displacement away from the array. Displacement, right? I get a lot of questions. What is displacement? And I've been asked about it for some time, and I've had to save it for this chapter as it's the most relevant to chapter 4. Now, displacement is a clear move away, which leaves an imbalance, right? So you see we traded into this premium, and you see this candle here, it created an imbalance from this candle's low to this candle's close. There is only sell side offered. That is an imbalance in price. There's no overlapping of buying happening here. Now, in addition to the displacement offered here, it also took out this low, which shows what a change in the state of price delivery. And why is that? It's because we were retracing up higher, offering higher prices, right? And then what happens? We touch the premium array, and the first candle, moves away from it. That's not what excites you though. This candle is what starts to green light you. This is the one that the algorithm has considered. So let's consider and let's talk about how we should see it from the algorithmic point of view. The algorithm, it looks to deliver liquidity and rebalance areas of imbalance. And the way it does that is through time and price. So the market's objective is to deliver liquidity and rebalance imbalance. And how it does it is through time and price. Now the price aspect of time and price is the references to price that we learned in chapter 2. So it's the price arrays and your liquidity pools, such as your highs, your lows, and those type of things. That's how the algorithm sees it. The algorithm does not see candles, it sees price ranges. Now, this order block is a institutional reference point. It's an array, and the algorithm is going to consider it. You see how we had no displacement away from these fair value gaps from here to here and here to here? That shows us that we don't consider this array. We are only considering the array which leaves us with displacement. That is how you're going to stay on side, because people may wait for here this fair value gap to be traded into, and then they might try to look for short position straight away, and then they got stopped out by this candle, and then they see this one and they're like, oh my god, it's going to go short, but there's no displacement. When you trade into the order block and you get this, that is what I'm looking for. That shows that the algorithm has respected this premium array. And how is it shown? It's shown by the displacement with the fair value gap. And if it does, which is good, it will take out this short-term low as well, but it doesn't have to. The imbalance is enough for me, right? Because if this candle didn't take out, the next candle most likely would have taken it out. What does a fair value gap show? Why is a fair value gap so significant in the displacement? Because the fair value gap is created when price moves away from an area fast. Now, why does the algorithm trade into a premium and then leave displacement showing a fast movement away from it? It shows that it's using this to frame the attack on the drawn liquidity. Otherwise, why would it be leaving a fair value gap or imbalance in the direction of it, right? That's the process that I have in my mind. So once you've achieved your displacement, you have to identify your draw on liquidity. You work down the range. Expect price to be met with resistance at every opposing array before the run ultimately on the low. And this is the reason why I outlined this low, right? Now, the ultimate draw on liquidity is this sell side draw here, right? The sell stops beneath this low. But you have to consider each discount array, right? So if you just think of price, right, from this low to this high and draw an imaginary fib, you can see that everything from my cursor beneath is discount, right? So this fair value gap, this low, this is something to consider before this low. You don't just go for this low straight away. You have to consider every single array, because you're going to be met with resistance probably in this down close candle, right? And I don't mean that it's going to reverse from there and go, start attacking buy side, but I mean it's going to offer maybe a retracement back into the range and then offer lower prices again until the sell side liquidity draws hit. Now, what is that called? That is called a high resistance liquidity run, right? When there are opposing arrays built in the opposing end of the matrix, so we're using the premiums to short. Now, if there's a lot of discount arrays built in the range, they're going to offer resistance to price before the run on liquidity. So this order block, this fair value gap, is likely to offer, a resistance before we try to run this low. That's high resistance liquidity run. If it was just one array, so maybe a fair value gap and then the low, that's going to be less resistant than if you have an order block, if we have a fair value gap and maybe like a mitigation block or breaker block, right? Those are things to consider. You are not just looking to attack this low first, you're working your way down the range, right? Think of the weekly commentaries that we done at the start of the mentorship. When we were attacking the buy side of the DXY, we done every opposing array and then the high of the DXY range. So as you can see, after displacement away from the array takes place, each candle, we're assuming we're going to start trading lower. You're only waiting for setups in line with your drawn liquidity. After this displacement has occurred, yep, the next candle trades higher, but it's not going above this order block. This is an order block. Why is it an order block? This is, the last up close candle before the move lower, and it's a change in the state of price delivery. We changed here, and then we moved away with the fair value gap, and we took out this low, right? Now, again, just to reiterate what an order block is, you went higher and then you went lower with a fair value gap. So you were offering higher prices and then straight away you're met with a reverse with shown by a fair value gap. That shows that it's a change in the state of price delivery. The fair value gap shows that it's really trying to offer lower prices. It's in a hurry to get lower. That's what that shows. And you see that it goes back into it. It's not going higher than the order block. And you'll see in here, once we come back high, close to this here, we're in a deep premium here. 1, 2, 3, 4, 5 day, short day trading setup days were offered here. This day, probably not, but look at the high on this day. You could have definitely caught maybe a few pips here and there, but these days are the ones that we want to consider, right? These days, if you're looking for shorts, you see how after this displacement, if you're looking for longs, look at how favorable the longs are. You would have got crushed by this. Looking for shorts and look at the short setups that present themselves after, you're looking for short setups, right? After this displacement, if you're hunting longs, you were never finding them really. Maybe on this day, yeah, you found one. But if you're waiting for shorts and you keep waiting for it, look what you would have got blessed with. These two candles. And now what are you assuming from here? Look at the displacement away. What is it reaching for? Clearly this drawn liquidity here, right? And each of these candles offered a high probability shorts on the intraday format, right? Now, touching back on the topic of the high resistant liquidity run, you see that we did trade lower, right? But we haven't taken out the low yet. So there was resistance met with the run on this low. Now, that's fine. That doesn't mean that, oh, we were wrong. When you see that it comes really close to the low, it's just generating more sell side liquidity, right? Let retail think that this is a double bottom forming. And then what's going to happen? We're going to retrace higher, formulate more, bearish signatures inside of this premium of the array. I mean the premium of this range, and then you're going to use all of that to then attack the sell stops, right? You need to go higher to generate and accumulate more short positions, right? Because the buying up here is going to be paired with more selling, and then we're going to attack these sell side draws, right? Now, apply the same process again that we done at the start, right? So remember at the start, element one was you want to draw out your fib high to low. So you have your high to low. We use this high to low first. Now we're using this high to low, right? Identify the premium and the arrays within the premium. So we have this fair value gap that extends from the discount to the premium. So we still consider that. And we have this fair value gap in that upper end of the premium. We're considering the first array. Remember, we're hunting at each array until there's displacement offered. If there's no displacement offered here, we'd wait for here and essentially into the rejection block until we get that displacement away, right? No displacement means that you cannot frame your target. The displacement away from the array is what's going to save you from being offside in the market. If there's no displacement, don't try and day trade the next, don't try and frame a narrative without it. The displacement is what's going to green light you to your draw on liquidity. Then you start trading towards your draw on liquidity on an intraday time frame. This is what we've been doing in this lesson. Now, we trade back into the premium and we go back into this array. Now you see how we're just, flirting around the range and we create equal highs. Well, from everything you've learned up until now in the mentorship with all the weekly commentaries we've done and everything else, you know that these equal highs in the premium price is likely to drive above the equal highs and deliver us into a bit more of a premium and then offset lower prices. Now, what do we have here again? We have displacement away. And how do you know it's displacement? Look at the imbalance left with the candles, right? Look at this imbalance. Now, what is it clearly aiming for? It's aiming for this sell side draw. Now, look at how many high of the days were made within this premium. One, two, three, four, five, six. This one's the only one that didn't. Seven, eight, nine, right? There was many high of the days made in this premium. Now, even these days offered some sort of short setup. But look at this. When you have this candle, right? When you have this candle looking clearly to attack these sell side draws with the displacement, you know that you are now looking only for short positions until you attack this drawn liquidity, right? This is all the framework you need, guys, right? Identify the range, premium and discount, assuming that you have your overall bias, right? Because we're short on the euro, we're only waiting for premiums to then make short ideas. Wait for the move into the premium and then wait for displacement. And that displacement, then we're chasing intraday setups. That's it. That's all it is in this lesson. Now, you can see that after we got the displacement away, look how many short days were offered, right? This candle comes up and rebalances 50% of this imbalance, which is something that we've covered on extensively in this mentorship. And then you have this candle, and you have this large range candle. What's that? Maybe 150 pips, close to 200 pips. And that is, you know, meeting the sell side draw on liquidity, right? Now, once the sell side target is met, you have to ask yourself two things. Is this the sell side target, or is there a greater sell side target maybe on the weekly? So there may be a low that is lower than here that price is reaching for. But this, if this is the low, that and there's no low really after that, after every single time you are breaking the low and you break it like this, you do not want to look for short setups again. Why is that? Let's add some logic and let's apply theory that I've taught you to why we won't entertain short setups once the lows are purged. What rests beneath the lows? Sell stops, right? And what are sell stops used for? That is a counterparty for who? That's the counterparty for smart money longs specifically, right? These sell stops, smart money are going to pair that sells all that selling, all those sells, they're going to pair that with their long positions, right? And that doesn't mean that they're going to flip it all the way and start becoming bullish. No, they're going to just pair that long, right? Pair their longs with those shorts, maybe to rebalance this candle or to then, offer again a premium like here. Offer a premium, come down, and then come down again, right? That's it. You don't want to be short after this target is hit unless there's a greater target on the table. In the context of here, there was not a greater target offered on the table, right? You are not looking for shorts once the sell side target is met. So what do you hunt for on the intraday? When you have you traded into your premium discount array and have found displacement, you are now hunting day trade setups in line with your draw on liquidity. These 2 days of trading were the down days offered away from the Euro USD premium order block. So just for reference, it's these two candles, right? One and two. This is the what we're considering now, right? That were down close candles. So because this is a bearish example, you're expecting price to keep trading lower until the drawn liquidity is hit. After this day, right, it's easy. If you're on the low time frame, you think, okay, we traded down lower today. If you're just stuck on a 5 minute time frame, for example, tomorrow may be higher. No, you're considering the higher time frame drawn liquidity. You are only looking for shorts until the higher time frame liquidity is hit. That's it. Every single day trade, you're looking for short positions. That doesn't mean you're just pressing sell. No, you're waiting for a setup that is going to enter you short in a logical area where you're going to profit from selling, right? Now, this is just, the same thing that I showed you in chapter 3, lesson 3, and essentially it's the anatomy of the daily candle. Now, how does a daily candle form when it's bearish? When it's a down close day, the high is made early, and then the rest of the day, the range is used to push lower, lower, and then the low is close to the close of the candle, right? Now, the times of day you want to consider is the London open kill zone and the New York open kill zone. Look at the move that's bang on in the middle, 8:30 New York, something that we've touched on in the weekly commentaries as well. And you got this move lower, right? Now, in this day, there's not really much offered. There wasn't much of a retracement. Look at the high of this candle, not much of a retracement, right? The only possible retracement offered was maybe this, right? Into here, into this rebalancing this candle and then moving lower. And there was no retracement offered into this fair value gap, right? But the whole idea that I'm showing you is once you have traded, once you have found your displacement here, you're expecting each day to go down lower. You're expecting the daily candles to look like this. And why is this important? Because you know exactly now what to look for, right? You're looking for candles to look like this. The high to be made early, and you're waiting for retracement entries to be entered short until your higher time frame drawn liquidity is hit. So what happens when you don't wait for displacement away from your array? What happens when you don't trade with these elements that I showed you? You get stuck in what is called the chop, this sideways consolidation, and this is very frustrating. Why? Because your drawn liquidity on the higher time frame isn't going to be traded to until there's displacement away from the higher time frame array, which shows that the algorithm is indeed looking to start delivering liquidity. That is why displacement is so damn important. Without this is before the displacement, right? You see, that is all of this. You see this, right? In that is this. You see all of this before this displacement, it's all of this sidewaysness, yeah? This is what you get, right? You need that displacement so that you can start entertaining your high probability day trading setups. Because once you get your displacement away from the high time frame array, you get clear down close candles, clear nice range day trading setups that are going to offer you many pips if you can get in line, rather than if you want to trade this and stuck in consolidation half the day. I know what I'd want to trade, and it's going to be this. Wait for displacement away from the array, and you'll know how the daily candles are going to be forming. Now, if this was bullish and you got displacement away from your discount array in a bullish context, you're just expecting the opposite of this. You're expecting the up close days, the low of the day to be made early, and the rest of the day to expand higher. So in New York, you'll find a retracement to go long again, something like that, right? Now, I haven't gone into the specific what to look for because we just don't have enough time in the lesson, and it's going to be talking on too many topics and it's going to lose focus, right? Now, this is a 4 hour example, and this is just a 4 hour example of, you see this retracement from this high to this low. We have now just depicted it on the 4 hour. So 3 slides ago, the orange box that I showed you, we saw a retracement back into the range before attacking the sell side target of the daily low. And this is just a 4 hour depiction of the retracement. The 4 hour is the lowest time. Remember, it's the lowest time frame we use to frame price arrays to formulate day trading ideas. You are not using your 1 hour. You guys know from experience, right? Some of you have tried using just the 15 minute and the 1 hour, and you get lost in the source, and it's it's not fruitful, right? Now, the red box is a fair value gap that extends into the premium, so we monitor and we outline that, right? This is the first array in the premium, right? Now there's this mitigation block. There's these two order blocks, right? There's this entire fair value gap as well, and we're just monitoring each one, right? That's it. Monitoring each one. If price goes and trades all the way past this one, guess what? On the 4 hour, we're not going to enter off that. That's fine. We're waiting for clear rejection and displacement away from our arrays, right? Now, something that I hunt, and I love this so much, and this is something that I use all the time, and I'm sure I've touched on this in our weekly commentary before. You see this, right? This wick, and it's a high. Remember, this middle candle, the high is greater than the candles before high and the candles after the high of the candle after, right? When it trades into the premium, into the fair value gap, and it clearly rejects, and look at the close of the candle, it's so close to the low. What do you think? If you didn't have all of this price action, wouldn't you think that the next candles, or the next few candles at least, right, are going to trade lower just based off this, that we went higher and then we came all the way back down? And the context of it is what? Think of the entire context of it. The Euro USD sentiment is overall delivering lower prices. It's bearish overall. Now, on the 4 hour, we retraced into a premium, and the retracement into the premium was done with this long wick that rejected all the way down. Bearish candle closed near the low. The next candles, in my opinion, out of 100 times, most of them, I think, the next candles will trade lower. And that is all you need to frame a day trading setup, especially in the 4 hours. From this candle to here, that is maybe 100 pips on the Euro USD. That is more than enough for a day trading setup, right? Now, once we have this, right, once we see this, we go and hunt for day trading setups. So, as expecting lower prices, we frame logical retracements intraday using time of the kill zones, the London open kill zone, New York open kill zone. Now, the yellow box I have outlined is a breaker block, high, low, high, high, and we go lower, low. And the lines here, 1 and 2 here, that's a fair value gap. Now, what happens? The Asian range was declining. It wasn't in a clear consolidation, and I've taught that to you in chapter 3. What happens when that happens? You get London slop. London isn't the one that you want to trade, it's New York. Now, when New York opens, and in New York's open, you get this displacement down. And that displacement down is in line with our narrative. You see how everything is clicking together now? Everything is pointing towards lower prices from the rejection up here, and we're moving down, all right? And you see, look, we're taking out this low as well, right, on the lower time frame. But remember the 4 hour, this rejection up higher, we're looking for lower prices. Now, intraday, the next day, we got displacement in New York, shown by the fair value gap move lower. What do we hunt? Retracement back into the fair value gap, paired with the breaker block, and it's OTE as well. From this high to this low is OTE. That is enough for a day trading setup. Stop above here, and where would your take profit go? Let's go back. On the 4 hour, remember the topic of high resistance liquidity runs. You have a mitigation block and you have order block placed in the discount of this price range. So the run on the low, you may not get it in one go. So you have to consider the discount arrays. You would take profit at the first opposing discount array. You wouldn't reach for all the lows. Look here, look. This is the order block on the 4 hour. You'll outline it and you'll keep it there, because what can you expect here? You can expect rejection to reaccumulate more short positions to then start attacking the low again, right? That is why you take profit, and make this in your notes. You take profit at the next opposing array on the higher time frame PD array matrix, right? So that's the end of chapter 4, lesson 1. So I hope you guys like the new format. I feel like it's more focused, right? It's clear slides, there's clear talking points, there's annotations. You can pause the video, you can make your notes. It's a lot more, you know, condensed, straight to the point. So if you guys enjoyed it, let me know if you guys enjoyed this way, you know, over the prior method that we were using where there was no PowerPoint, so just me showing you on the charts. This is probably the way we're going to continue with now. Chapter 4, there's not going to be many lessons, because just the nature of it, there's not really much to show. The intraday stuff isn't complicated. As you can see, it's all higher time frame. Everything on the higher time frame needs to make sense. Intraday setup is the last thing you guys look for. It is the last thing you guys look for. You wait for the displacement away from your array, premium discount, and then you are hunting day trading setups in line with your draw on liquidity after the displacement is occurred. Okay? Now, if you have any questions with this, let me know. I'll be more than happy to answer like always. And until next time, I'll see you guys in the next video.